Hello, this is J. Mike Perkins, and welcome to the Mortgage Education Channel. And on this episode, adjustable rate mortgages explained. First, I'm going to answer the question, why do adjustable rate mortgages exist? Next, I'm going to go over how adjustable rate mortgages work. And finally, I'm going to try to answer the question, should you consider getting an adjustable rate mortgage? So why do adjustable rate mortgages exist? Adjustable rate mortgages exist to protect the lender in case the interest rate goes up in the future. Put yourself in the lender's shoes for a second. Let's say the lender makes a 30-year fixed rate loan when rates are really low, say 3%. And then shortly after that, interest rates go up, say to 6%. The loan that the lender is holding at the 3% interest rate, which is fixed for 30 years, is now less valuable because new loans coming on the market are paying a much higher rate. So if the lender needs some cash and goes to try to sell that loan at 3%, they'll have to sell it at a discount. There are two ways the lender can avoid the risk of rates going up in the future. The first one is to sell the mortgages that they create shortly after they make them, when rates are still low before they have the chance to go up. And second, they can make an adjustable rate mortgage because then the lender is transferring the interest rate risk from them to you, the borrower. Now, sometimes you don't have a choice. There are certain loan programs out there that are only available as adjustable rate mortgages or as fixed rate mortgages. But most of the time, you're going to have a choice between a series of fixed rate options and a series of adjustable rate options. But before you consider an adjustable rate mortgage, you need to understand how they work. The first thing that you're going to see is the adjustable rate mortgages will have a low introductory rate, which is typically lower than the current 30-year fixed rate. However, that introductory rate is going to expire after a certain period of time. And then you'll be subject to whatever the normal interest rate is at that time, unless there's some sort of restriction on how much it can go up. The next thing that you're going to notice is that the sooner the introductory rate expires, the lower it is. For example, if you've got an adjustable rate mortgage that's fixed for the first 3 years and then starts to adjust, it will have a lower introductory rate than the one that's fixed for the first 5 years. And the one that's fixed for the first 5 years will have a lower introductory rate than the one that's fixed for the first 7 years. After the introductory period ends, the loan will start to adjust. Now, typically, adjustable rate mortgages will adjust in the rate once a year. However, some of them adjust every 6 months, and other adjustment terms are possible. Finally, after all of the introductory stuff expires and you're subject to the normal rate, that rate is called the fully indexed rate. And that is calculated by taking the value of the interest rate index, the current value at that time, and then adding a margin to it. So, for example, if the index value is at 4% and the margin is 2.75%, then the fully indexed rate would be 6.75%. The interest rate index value will obviously go up and down as interest rates go up and down, but the margin amount should be fixed. The lender has some choice over what is used as an index, and it's changed over the years. Right now, the most popular index value is either a specific U.S. Treasury instrument or some index of several of them together. Margins can vary, but what I typically see is somewhere between 2 and 3%. One thing that is very important to me, if I was considering an adjustable rate mortgage, even if my intention was to refinance the loan before it starts to adjust, sometime during the introductory period, and even though I'm paying the low introductory rate right now, I would want to know what is the current fully indexed rate on this loan if I wasn't subject to that introductory period. And if the fully indexed rate right now is substantially higher than the current 30-year fixed rate, what that is telling me is if I had to keep this mortgage for a long period of time, it would probably be expensive. When you start shopping for adjustable rate mortgages, you're going to see terms like 3 one-arm, and 5 one-arm. Well, you need to know what that means. A 3 one-arm would imply that the low introductory interest rate will be fixed for the first 3 years, and then it'll adjust once a year after that. A 5 one-arm would imply the low introductory interest rate is fixed for the first 5 years, and then would adjust once a year after that. If the second number is a 6 and not a 1, that would imply that the loan will adjust once every 6 months after the introductory period. So a 5/6 arm would be fixed, that low introductory rate, for the first 5 years, and then adjust once every 6 months after that. You need to find out if the adjustable rate mortgage you are considering has what are called caps. Caps limit how much the interest rate can increase. A cap of 2.5 would imply that each adjustment is limited to 2%, and the total increase in the interest rate on the loan can't be more than 5% above the initial interest rate. Although caps of 2 and 5 are the most popular, the loan you may be considering may have different caps, or it may not have any caps at all. And finally, you need to find out if the loan you want has a prepayment penalty on it or not. If so, you need to find out how much that prepayment penalty is and when the prepayment penalty will end. To wrap up this short video, should you consider getting an adjustable rate mortgage? Well, for one, I wouldn't get one if you don't understand how it works. I also wouldn't get one if having a fixed payment is essential to you. And also, you need to look at where current interest rates are. If current interest rates are anywhere near historic lows, then odds are they're just going to go up in the future and not go down. And that would make an adjustable rate loan not particularly attractive. I would always look at the fully indexed rate of any adjustable rate mortgage you were considering, even though you're going to be paying the introductory rate and you plan on getting rid of the loan before it starts adjusting. You need to know how expensive that loan would be if you had to hold it for a long period of time. An adjustable rate mortgage might make sense, and it might be attractive to someone that knows that they're not going to be in the home that long. Therefore, they could take advantage of the low introductory rate and not have to pay more later on. I hope you found this interesting. Thank you very much for watching. I'm J. Mike Perkins.